Good evening, and welcome to another Life After Hours. Let me know in the chat where you're joining us from, but it's certainly a wet evening here in Sydney, which I guess is my cue to acknowledge the Camaragal people, the earliest recorded inhabitants of the land that today we call North Sydney. Now, the topic for tonight is, of course, the very newsworthy 2026 federal budget. Those of you who've been following along at home will know that Glenn James, myself, and Victoria Devine were in Canberra in the budget lockup for the event. And of the 36 budgets that I've followed professionally, this is the first time that I actually did it from the lockup. But before we move into talking about the budget and the newsworthy, we've got a little bit of a poll, which I'd like to... you guys are well into it. You're well ahead of me. So, so let me think about... let us know what you think about the budget, and we can come back to that later in the show. One of the so we've got some Melbourne, Mooney Ponds, G'day from Italy, from Sydney, so a bit of a mixed bag. But as I was saying to Paolo before we came on air, this is my 36th federal budget that I've followed professionally. And of those, that there's probably only 8 of those that were historically consequential, either because of the legacy they left behind them or because of the immediate pressing need that they solved. And so, you go back to the Keating budget in 1991, which brought us compulsory super, the Costello's first budget in 1996 that delivered pretty massive spending cuts, what today we'd call an austerity budget, and ushered in a period of a decade of budget surpluses. We then had the 1998 Costello budget, which brought us the GST. Then fast forward to 2006, again a Costello budget, brought us the Future Fund and the fundamental changes to super, bringing in tax-free retirement income and tax-free super for over 60s, and the transitional 1 million annual one-off contribution. The Swan budget of 2009, which was in the aftermath of the initial start of the GFC, which just poured cash into the country. That's sort of Ken Henry said, Michael Parkinson said, go early, go retail, go hard. And certainly the Swan budget did that. Swan's 2010 budget the next year lifted the super guarantee charge to 12% and brought in, or attempted to bring in, the aborted resource super profits tax. 2012, though, again was a Swan budget, I think, which laid the foundations for the NDIS, and we all know how well that's worked out, and some significant early aged care reform. And then the 2020 COVID budget, which again replayed that 2009 playbook and poured money into the economy. The other one, which I was a bit unsure about how to include in this, but the 2014 budget was certainly newsworthy, although much of its proposals never saw the light of day. That was a Joe Hockey budget. So these newsworthy budgets don't come across along every day. So it's hardly surprising that this current one has got a lot of press. Not all of it positive, and I must admit I feel a little strange finding myself on the defence of a Labor budget. And on the whole, I think this is a positive budget for most people. Will it do what they say it's going to do in terms of housing? I'm not convinced, but some of these saws needed to be cauterized with negative gearing, some of the trust stuff, and the legacy of the 99 Costello budget, which changed introduced the CGT discount, which was a handy shortcut at the time, but has certainly outlived its use. So I'm going to run through the big changes. Obviously, I'm not going to get through every page of every budget paper. There is a huge amount of paperwork to get through. And between being introduced to the lockup and recording a podcast with Katie Gallagher, Glenn, and Victoria Devine, and getting that on the air at 1 a.m., there was an awful lot of frenzied activity that you don't see when you sit at home and watch this on the ABC. So with that, let me fire up the slides. Slides, where are we? Here we go. So in case you haven't been listening, this is the 2026 federal budget. And I just want to unpack what actually matters for you and your money. Lots of noise, lots of color and movement, lots of ill-informed comment, and lots of cute internet memes, which is one of the joys of working in new media or the social media world. Not sure I'd want to be Jim Chalmers, but anyway, so we asked in the newsletter and in the various Facebook groups to let us have your questions, and certainly the stuff that bothered people before the budget. There was a lot of leaks here about what would happen, and certainly the CGT changes were fairly well telegraphed, although they weren't quite what we got. And so hopefully I can cover off some of those questions as we go, but definitely drop any questions in the chat. If you're feeling a bit shy, there's the Q&A section. Budgets are always a tough thing to put together, and it's certainly never been an ambition of mine to be part of creating one. But, there's three things that this budget was seeking to do. I'm not sure it's achieved all of them successfully, and in fact, achieving all of them is probably an impossibility. But certainly, one of the goals was to try and ease some of that cost of living pressure. Secondly, to do something meaningful about tax reform. And finally, to do something about future spending. And the NDIS is a big part of that, which has gone from nowhere to, in 13 years, has gone from nowhere to being the second biggest budget line item. And that, admirable though its aims may be, that's something that's largely unsustainable. And so the trick here is, how do you achieve those goals without triggering either a recession or further inflation? So by putting more money in the hands of the consumer in an economy where we've already got significant price pressures, you run the risk of inflating the economy, which is good if you've got some debt, but it's bad because the natural opposing lever to that is the RBA cranking up rates again. So there's this delicate balance between trying to keep the economy ticking along, take the pressure off households, and yet not trigger inflationary spiral. And that's the thing we've really got to watch out for here. There is a very real risk of triggering a 1974 stagflation spiral here. I don't think we're there, so I'm not being pessimistic, but this is a tough balance. And I think they've done a reasonable job, not a perfect job. So looking at the short, quick wins, easy to understand, the big new structural change, it's not a huge amount of dollars on day one, but I can see this as becoming a lever that future treasurers will pull now that the mechanism is in the system. And that's the WATO, or Working Australians Tax Offset, to add yet another acronym to the tax system. And this provides a tax offset to reduce your tax. And the big plus of an offset, as opposed to lifting the tax brackets or reducing the rate, is that it favors those on lower income. So everyone gets $250, whereas if you lift the tax-free allowance, those at the upper end of brackets benefit more. So I think we're going to see this increased in future years. So it's modest, $250, and you don't get it till the tax year after next. And linked very closely to that, but you'll get this in the next tax year. That is the one beginning on July 1, and that's a fixed $1,000 work-related deduction, which allows anyone with employment income to deduct $1,000. Again, trying to shift the tax away from working people and towards capital. And that's a pretty fundamental shift. These are very minor shifts, but it is a fundamental philosophical shift. So you'll get this in the 2026, 27 year. So if you take those two together with the already legislated drop in the bottom tax rate from 16% to 15% to 14%, that's worth about $900 annually to a typical worker. So not earth-shattering, but it will help to give back some of the bracket creep that's creeped in the last few years. Bracket creep was something that got a fair bit of press in Canberra, but I think much of that was driven by people with short memories. Certainly, we've seen some significant budget bracket creep in the last 5 or 6 years, but it's not that long ago when the top marginal rate cut in at $50,000. I think it's just over 20 years ago. So we've gone from 50,000 to close to 200,000 in the current budget. So that's well ahead of inflation. So the tax burden is falling, so that top rate represents about 3 to 5% of all taxpayers. So let's not get too hung up about it. So that's the simple good news, and not life-changing, but I think it represents a structural shift that we will see enhanced in future years. And that sort of brings me on to the topic of how does this all go from a speech in Parliament on Tuesday fortnight to actually impacting our hip pockets. So we get the budget speech on budget night. 2 days later, on the Thursday night, the opposition gives their budget reply, which is largely political theatre. Sometime later, there's a bill introduced to give effect of effect to the spending and tax raising provisions. That needs to go through both houses of Parliament. And that will happen relatively quickly. So we should see that go through in 6 to 8 weeks. There's probably very little risk of material changes happening given where the balance of power is. Or we may see some tweaking at the edges. And then the hard work begins, which is turning this legislation into actual mechanical bills. So legislating for announcing a 30% tax on trusts is one thing. To develop the hundreds or thousands of pages of mechanics that make that happen is something completely different. So we'll see that play out over quite a lengthy period, which is partly why a lot of this stuff doesn't cut in until the 27-28 budget. So I think we can be reasonably comfortable this will get through Parliament relatively unscathed. So the big noisy changes, the ones that have been getting most of the press and the ones that the government wants to highlight, is to focus on what's happening with property. And the two big things here are CGT and negative gearing. And both of those were fairly well flagged. So much of the juice in property investing in Australia comes from the ability to transfer a loss made on the property to reduce other income, and then any gain on the property in due course is taxed concessionally. So that's played a big part in the after-tax returns for property investors. So if you take a typical residential property in Australia, you might get a gross rental yield of 3 to 4%. So that is a $1 million property would generate $40,000 in annual rental income. You then have agents' fees, maintenance, land tax rates, and that will generally give you a net yield of 2 to 3, and you're borrowing money at 6%. So most people are going to be negative by 2 to 3%. More if you've used your home equity to 100% debt fund the property. And so those losses were allowed to be used against your personal income. And if you're a top rate taxpayer, that means the tax office is wearing almost half of your loss. And then when you sell and realize your capital gain, you paid tax on half of it. So all of those favored property. So the government said, well, actually what we're going to do is we're going to say we're going to quarantine those losses going forward. So you can only use your losses on property against other property income or the capital gain when you eventually sell a residential property. So rather than taking that deduction every year straight across to your salary and wages income, you have to carry it forward until your property either becomes positively geared, which can take decades, depending on how highly geared it is and what interest rates are, or when you eventually sell the property. So the time value of money means that reduces the return on property. But there's a couple of caveats there. So firstly, if you already own the property before Tuesday night, you get to keep applying your losses. If you buy a new established property, you don't. But if you buy a new property, newly constructed property, you do get to keep it. So the expectation that the tax policy is intending to create here is an incentive for investors to buy new properties and hence help developers get new developments out of the ground. And secondly, by taking some of those buyers out of the established property market, you should see downward pressure on future house prices. All of these are intended to be fairly modest. The Treasury modelling was suggesting that this would take 2% annual price growth out of the market. So if the property was otherwise going up at 6% absent this change, it should go up at 4%. And it should deliver 75,000 new first home buyers over the decade. That's a very modest push. And the economics are reasonably sound, but it's not a life-changing difference for most people. But certainly taking a bit of the heat out of the market is good. But the caution I would say to most investors is that a tax benefit will never save a dud investment, and buying new in order to get the tax benefit could very well be a Pyrrhic victory. That is, the tax benefit will be priced into the purchase price of new properties because they'll be bid up, and property investors will now join overseas investors in the new property market and be largely excluded from the established property market. So it's not rocket science to know that brand new property has underperformed established property as a category for many decades. If you do strip out, house and land packages on the edge of town, off the plan high density apartments in city centres and some growth corridors like the Macquarie Park Epping corridor in Sydney, if you strip those out, much of that difference disappears, but it is a clear issue. So very much be cautious about allowing that tax tail to wag the investment dog. So that's the big change there. And so how that will play out is that if you don't have the negative gearing benefits, your ability to borrow falls, and we're seeing many of the banks reissuing their serviceability calculators to show this lower borrowing capacity. And since the price of new property is fundamentally a function of credit availability, this is where the downward pressure on prices comes from. I don't think anybody is suggesting that we're going to see a massive decline. This is not 1969 or 1991. We're not going to see a massive fall in house prices, but it will certainly take pressure off the market. So lower borrowing capacity, inability to transfer those losses to against income, and so what we're going to see here is fewer investor buyers. Those who do buy established property will be going for lower levels of debt and hence less able to compete on price. And we'll see more demand for new property, which should see supply come through, which will have a flow-on effect to pricing in the established market. But this is not a collapse. This is not the end of the world as we know it. These are modest changes, but they're changes that had to be made. The next change is to the capital gains tax regime. And one of the fundamentals of a tax on capital gains has historically been to remove from capital gains the growth that's solely due to inflation. So when capital gains was introduced in 1985, 86, at least in the mid-80s, there was an ability to what was known as indexing your cost base. So if you bought something for $100 and inflation was 5%, you only paid tax on gains above 105. And in those days when we had, inflation was starting to come down, but we still had periods of double-digit inflation, certainly in high single digits. And for much of the 90s, we didn't see property prices rising much more than inflation. So, but it was a fairly complicated calculation. You had to record, particularly for shares when you were buying and selling, you had to go and get the CPI index number from the tax office. You had to upgrade your cost base and calculate your gain. And so Peter Costello in 1999 says, well, let's simplify that. Let's call that 50%. And, when you looked at house prices, had inflation of 4, 5, you had house price growth of 5 to 6. So Sydney's 40-year average house price growth is 5.8%. And average inflation of that period is almost 3. So, that's not a million miles away from 50%. That if you look at the best research available on long-term Australian house prices, the Stapleton study, until the 80s, house prices grew at about inflation plus 1. More recently, it's closer to inflation plus 2. And as I said, 40-year Sydney house prices 5.8. We have obviously seen periods where they grew much faster than that. Certainly if you look at the period around the introduction of the GST, particularly in Sydney. So Sydney house prices did next to nothing through the 90s, but had a massive spurt between 97 and 2003 where they more or less doubled. And so in those windfall periods, you will pay more tax under the indexation model, but in a stable CPI plus 2, CPI plus 3 type growth, it's not that dissimilar. And so this is sort of a more pure version. So I think, like it or not, this is from a tax philosophy viewpoint, is a better answer. And of course, the technology for tracking this stuff is so much easier than it was in the 80s and 90s. So that's probably the good news. The lesser news is, well, first of all, the assets that were around before CGT was introduced, so pre-1985 assets, will come into the CGT net from July 1, 2027. And that is, a 40-year grandfathering period come to an end. Hardly anybody picked that coming. And that is quite unusual. But I suspect the number of pre-1985 assets still rocking around is that are not principal places of residence, I suspect are relatively small and getting fewer every year as the people who bought those die and they get reset. And then the other big one is the introduction of a floor on the gain, of the tax on the gain. So broadly, we're saying if you buy something for 100 and inflation is 3%, every year you hold it, your cost base goes up 103, 106, 109, etc. And you calculate the gain by deducting index cost base from your sale price. And then you add that to your ordinary income, and that's how you pay tax. And the sting in the tail here is that if you had other income of less than $45,000, you will now be charged a minimum of 30% on that gain, which if you're earning 45,000, you're paying 32% anyway. So it really only applies to people who have other income of less than 45. And the classic place where that would have arrived is that people wait till they retire before they sell long-held assets. And to manage some of the impact, they say, well, look, if you're in receipt of an age pension or other income supplements, you won't pay the 30% minimum tax. So this will only apply to people who have other income of less than $45,000 and are not in receipt of an age pension or other income. So I suspect it's a fairly small category of people. The maximum impact of it is about $9,000. So if you had a $45,000 gain on the old system and zero other income, in the old system, you would have paid half your marginal rate on 45, which at that point is zero, or net zero on all of that. It's zero on the first 18,200, and then 15% on the next up to 45,000. But every dollar over 45,000 will be taxed at 32 cents. So that's about a $9,000 extra tax bill. So timing your sale will be important, and it will encourage people who are over the age of 60 to put more of their assets into super, neither of which I guess are particularly onerous. So they're the big changes. We've done some modeling here at Life Sherpa. So if you'd held VDHG, the Vanguard Diversified High Growth Fund ETF, since it listed in 2017, you would pay less, as long as you weren't caught by this 30% provision, you would pay less tax under the new regime than under the old regime. And the same would apply if you use the equivalent managed fund back to 2003, I think is when it was launched. So, and that's because despite its name, the Vanguard Diversified High Growth Fund has delivered about 9.5 since listing, or average return, and about 4.7 of that is capital gain, and inflation is average sort of 3-ish, 2.7 to 3. So when you do the maths, you end up with a slightly lower tax rate on VDHG than you under the new regime than under the old regime. If you get caught by the 30% minimum, then you will be worse off. But I guess that's the point. And this is really about trying to bring the taxes on capital more closely aligned to the taxes on labor. And that's a philosophical decision that you may or may not agree with, but that's the purpose of this. And that to me seems like a good thing. The other change, which obviously applies to a much smaller group of people, but will have a particularly material impact, particularly on people who are using the so-called bucket company strategy. So the advantage of our trust in Australia, and they are a peculiarly Anglo invention that date back to the Crusades, but typically, with a trust, you have to distribute all of the income to somebody. So the idea is that a discretionary trust allows you to distribute the income to lower taxed members of your family, and ultimately to take the surplus income that no one needs to spend and distribute it to a company. a so-called bucket company where it can pay 30% tax and accumulate it forever until it can eventually be distributed as a franked dividend to a lower rate taxpayer. So the two changes here is trust will now be subject to a tax of 30%, which will pass out to a beneficiary a little like a franking credit light. The difference between this and a franking credit, though, is that it's not refundable in cash. And there's a very strong argument as to why franking credits shouldn't be refundable in cash, that was not the intent. And the effect of that has been to turn our company tax rate into a withholding tax. That was certainly not the intention. And I think the change that brought that about was a unintended side effect of trying to fix a few technical problems with the original franking. But setting that aside, the new trust will pay tax at 30%. Beneficiary gets a credit for the 30%, but it's not refundable. So if their tax rate was otherwise less than 30%, their tax rate now becomes, in effect, 30%. Companies, though, will be denied a credit for the a credit for that tax paid. So if you distribute from a discretionary trust to a company receives that as taxable income and will pay 30% or potentially 25%, but more likely 30% tax on that, and then pay it out as a franked dividend to a investor who, let's say they're a top rate taxpayer. That person will then pay 17 cents on it. So they get a credit for the franking credit and pay 17 cents. So the total tax paid 30% by the trust, 30% by the company, and 17% by the individual. So that has effectively killed the bucket company strategy from, well, let's say 1 July 2027. And some people have asked me, well, why do they not give the company a credit for it? And for the most part, it wouldn't have made any difference, because if you can think of a trust distributing taxed income, having paid 30% tax on, let's assume the company does get a credit for it like they would if it was a franking credit. Company now receives $100 or $70 with a $30 for franking credit or credit. And so it now has $70 and no tax paid. Now it's going to make an unfranked dividend to the recipient, who will now pay their full marginal rate on it. So the net effect of that is identical, to the extent that it's not refundable. So I think that was just a simple one. So I think that is probably, that's going to change the bucket company strategy. In fact, it's kills it. Now, there are some potentially unintended side effects here as to whether a testamentary trust, which is typically a discretionary trust, whether it gets caught in it. As announced on budget night, ones that were in existence on budget night would have been grandfathered out of this regime. It's not entirely clear what will happen to new testamentary trusts that pop up having been in wills that were existing. And the better technical analysis is that they will get caught by this. But I have a very strong suspicion that will end up being carved out because of the death tax type scare campaign. So I suspect that by the time this legislation sees the light of the statute books, there will be a carve out for testamentary trusts. So they're the really big ones, and that's really a big deal for small businesses, many of whom operate under trusts. But it's really the final distribution to people who pay less than 30% tax or to companies. And there's some proposals that there be some transitional relief to allow you to restructure. So we haven't seen those, but definitely bucket companies would appear to be dead. There were a bunch of other minor changes, childcare rebates, fuel, and other support payments. Probably the one big one in here that will affect some people, but not for some time, is the reduction in the incentives to buy electric vehicles. So currently, electric cars are FBT, zero rated for FBT. That will be reduced to a 25% discount on the FBT in 2029. So existing leases grandfathered. Most new leases won't be impacted until 2029. So it's probably not a lot to be too worried there. Other than if you're going to buy an expensive EV, you want to get in before 2028. The good news is zero change to super. I mean, we'd already seen the finalisation of the Div 296 on higher balances. So super is now going to become a much more attractive regime. The change to the capital gains probably reduces the disadvantage for investment bonds. So I think we'll see them have a bit of a resurgence. And getting back to basics, you still need to manage your cash flow. You still need an emergency fund. You still need to pay off your debts. You still need to prepare for the unexpected. And obviously, super and investing never go out of fashion. So is there anything you should be doing different? Clearly, 100% geared investments into established real estate become much more problematic, especially if we're likely to see lower capital growth. I'm very skeptical about the wisdom of allowing that tax tail to wag the investment dog and drive you into buying new property. I think the sweet spot is knockdown rebuilds to build a duplex in middle ring suburbs. I think that's where the action is likely to be. If you can subdivide a block or replace an existing single dwelling with a duplex, that's to me where the real excitement is here. But I would still be recommending that people steer clear of house and land package investments on the edge of town and off the plan high density apartments in the city and some of those so-called growth corridors. No, none of this changes the fundamentals of asset allocation. It will change some of the timing at which you dispose of capital gains, but there's nothing here that says to me that an individual should change the fundamentals of asset allocation and start moving from in accumulation targeting growth over income. There's possibly an argument that if you're outside super but of retirement age living on dividends and selling down, you should probably be biting the bullet and moving that into super before you retire. So there's a bit of strategy around there, but for the average investor, the fundamentals of investing haven't changed. The changes are fairly well at the margins in normal market conditions. It probably encourages pooled investments, so ETFs and managed investment schemes and LICs over holding individual shares. But moving beyond that, I don't think this is world-shatteringly changing for investing. So if you're saving for your first home, FHSS has always been and continues to be the great opportunity, and super for retirement. So what am I saying? Don't panic. Talk to your advisor. Wait for the legislation before doing anything, and be very careful of allowing the tax tail to wag the investment dog. So that brings us to the opportunity for Q&A.